Hello, and welcome to our first investment strategy update for 2023. Has the tide turned for the global economy? Well, latest developments show that economic and financial pressures are easing. Inflation is slowing thanks to falling energy prices and recovering supply chains. And at last, China has reopened. As the country's government and central banks support the economy through this volatile process, domestic demand is improving and better prospects for China's property and technology sectors should take growth to around 5% this year. Meanwhile, the reopening should not significantly contribute to global inflation thanks to improving supply chains and despite some rebound in commodity demand. Faster Chinese growth will be good for the rest of the world and particularly emerging economies, partially offsetting the slowdown in other major economies where central banks continue to fight inflation. In the US, we expect the Federal Reserve to take rates to a 5% peak and then keep them unchanged for most of 2023, while watching the impact on wages. As tight financial conditions slow demand in the US, we expect a short-lived recessionary episode driven mostly by low private investment, especially into the housing market. This downturn may take inflation below 3% by year-end. In Europe, growth will also contract as the European Central Bank takes interest rates into restrictive territory. While the Fed focuses on labor markets, the ECB's policy depends on an improving energy outlook and falling gas prices. A mild winter, high gas inventories, and investment in alternatives mean that prices are now back to levels last seen in 2021 before the Ukraine war. Taking a global view, disinflation and the end of monetary tightening does not mean that central banks' jobs are done. Inflation is still high and volatile. We will see some recessionary episodes before recoveries later this year. How should we be investing in this year of transitions? Let's turn now to Stéphane to find out.
The new year has brought some fresh market optimism, but given the short recessionary episode expected by Sami, that may be premature. Indeed, as economies contract, so will corporate profits in many markets. We prefer to take a balanced investment approach. While still favoring quality, we have increased our equity allocation to neutral to capitalize on several opportunities. First, Chinese equities will benefit from the accelerated reopening, so here we retain our overweight exposure. Second, we have raised emerging market equities as they should also gain from Chinese recovery. Their stock valuation are attractive and the macroeconomic outlook is improving in many emerging economies as inflation slows. Third, Japanese small and mid-capitalization are well positioned to profit for improving domestic demand as wages rise. In fixed income, with high recession risk, we still favor quality bonds, namely US sovereign debt and investment-grade credit. Meanwhile, we see carry yield through Brazilian government bonds where rates have peaked. In currencies, while it may be too early to expect broad dollar weakness, we have raised our exposures to the euro and the Japanese yen, which should appreciate further. We also keep our overweight position in alternative macro and trend-following hedge fund strategies, which can offer diversification in volatile markets. Greater volatility is inevitable and instability can come from many angles. First, from inflation, from any obstacles to China's reopening, or from growth concerns as economies navigate recessions. Finally, fragmented geopolitics could easily change investor sentiment. The risk that the Ukraine war intensifies and the complexities of US-China tensions may be currently underestimated by markets. So while we have strengthened position in some risk assets in recent weeks, we have done so in areas that should be more resilient to these potential sources of concern. Our global risk exposure is now neutral, and we will continue to seize tactical opportunities as inflation comes under control and US rates approach their peak. Thank you very much for watching.